This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Rally on Wall Street. A bumpy week for stocks ends on a high note, and our market monitor has investing ideas for this market. Cutting ties. Business is separating itself from the gun lobby, but for funds, selling shares in gun makers is not that simple. Taking off. Would you get in a flying taxi? The future may be closer than you think. Those stories and much more tonight on Nightly Business Report for this Friday, February the 23rd. And we bid you good evening, everybody. I'm Bill Griffith. Tyler and Sue are off tonight. And once again, I'm coming to you from the New York Stock Exchange, where stocks rallied to end a choppy and sometimes confusing week. Equities have been getting pushed around by interest rates amid concerns that the solid economic growth we've seen could force the Federal Reserve to raise interest rates more times than anticipated this year. But a report released today by the central bank appeared to alleviate some of those concerns, and that's when stocks took off. The Dow closed at its high of the day, up 347 points to 25,309. The NASDAQ added a very strong 127 points. The S&P was up by 43, and today's gains helped the major indexes close higher for the week. And what a week it was. Here's Bob Pisani.
Stocks drifted steadily higher into the close, with the Dow up more than 300 points. Every day this week, we've seen some big intraday swings. Stocks would rise at the open, peak in the middle of the day, and then drift lower into the close. In some cases, there were concerns about higher rates and the Fed getting more aggressive, but often there was not a lot of news out there. Today, the rally finally held up. Lower bond yields were certainly a help all throughout the day. It was lower. The Dow, which dropped 2,500 points, by the way, about 10% in a little more than a week earlier in the month, has now recouped more than two-thirds of its losses. There's been a big rebound in cyclical names like Boeing and Caterpillar. That means investors still believe that the global growth story is intact. Now, the Federal Reserve bolstered that sentiment today with a report saying the jobs market continues to strengthen, hourly wages are growing moderately, and inflation should hit their 2% target by next year. By the way, Fed Chairman Jerome Powell will be testifying in front of Congress next week. Despite all the drama, the S&P ended the week just up fractionally. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And in Washington, the White House unveiled what it called the largest ever set of sanctions on North Korea. Now, the move is an attempt to further isolate the regime so that it feels pressure to give up its nuclear missile program.
Today's actions will significantly hinder North Korea's ability to conduct evasive maritime activities that facilitate illicit coal and fuel transports and limit the regime's ability to ship goods through international waters.
And President Trump today warned of what he called phase 2 if these sanctions don't work. Well, two major insurers are joining the list of companies cutting business ties with the National Rifle Association. MetLife is ending its discount program for car and home insurance for NRA members, and Chubb says it will stop underwriting NRA-branded insurance for gun owners. Meanwhile, car rental company Enterprise, which also includes the Alamo and National Car Rental brands, that has ended a discount for NRA members. That change effective late next month. And cybersecurity software company Symantec has also stopped its discount program with the gun rights organization. It had been offering a price reduction on Norton antivirus and malware protection for members of that group. Now, as some investors begin to reevaluate their gun stock positions, investment firms and pension funds have to prepare for a potential shakeup in their portfolios. But just how easy is it to do that? And what's the cost? Joining us tonight to talk more about this is Chris Ailman. He's Chief Executive Officer of CalSTRS, the world's largest educator pension fund. Chris, it's always good to see you. Thanks for joining us tonight.
Thank you, Bill. It's good to be here.
Now, we all know about socially responsible investing. You invest in what you support. Often it's environmentally friendly companies. You avoid what you oppose. Often it's tobacco or alcohol or even firearms. At CalSTRS, your mandate is simply to make money to sustain an enormous pension fund. But do you also consider yourself a socially responsible investor?
Bill, I'd actually say no, we're not, as hard as that sounds. We're a long-term sustainable investor. So if we think an industry does not have long-term legs, isn't going to survive, like tobacco or particularly some of these firearm products, then we're not going to own them. But not for a social reason, for an investment business reason.
And you don't just then sell. I know you're the type that wants to engage with some of those companies to learn more about their business practices before you make that final decision to sell, right?
Exactly, Bill. I've often said that divestment is not going to solve a social problem. You literally are just turning your back and walking away from it by selling the stock. We have found the best way is to talk to a company, to engage and talk back and forth, to explain what we're concerned about and try and raise it to management so they understand why we think it's a business risk. In some industries, like the tobacco industry, it's a single product, or in the firearm industry, they wouldn't even talk to us.
You know, the CEO of BlackRock said this week that they were mindful of what some of their investors felt about firearms manufacturers in the wake of the tragedy at Parkland High School. But at the same time, they're beholden to the indexes that they invest in for those investors who invest in index funds. Some of those firearm manufacturers are in there. So it's not so easy to be socially responsible when you are trying to make money, when you're investing on the scale that you do, or BlackRock or some of the other big investors, right?
Exactly, Bill. I agree with Larry Fink and the statements that BlackRock said. And my heart breaks for these kinds of situations. We care about so many, and I personally care about a lot of these social issues, but this isn't our money. This is a trust fund, and we're fiduciaries. So what we're trying to do is make a long-term investment decision. And I feel for many of my peers that are at the teacher retirement funds, and I know their members are angry they may own these, but as you said, they own them because it's the entire market. They just simply own the U.S. stock market. And these companies sell legal products, so they're in those indexes. And to pull one company out of an index means that now you have a little hole in that entire market that you own, and you can't trade it as well. And for mid-sized pension plans, they're in big commingled products, like a mutual fund, so they don't have the ability to say, don't own that one little slice. If you want to own the U.S. stock market and track the U.S. stock market, that means all 3,000 or all 5,000 companies, not just some subset of that.
Yeah. Before I let you go, you said something that intrigued me about the future of firearms makers. You think a lot of what's going on right now necessarily casts their future in doubt? Is that what you were saying?
Yes. Our board decided back in 2015 not to own firearm companies that made products that were illegal in the state of California. And that was an investment decision. It wasn't a social or an emotional decision. And the key for us was the recognition that we think, and although we were wrong initially, but we felt that regulations would come in effect that would potentially harm these companies, that these products weren't sustainable. They're not a useful product, and therefore we didn't think that these companies had a long enough life. And that's why we made the investment decision several years ago to get out of these weapons manufacturers, these firearm manufacturers.
Chris Ailman, who heads CalSTRS, the biggest educator pension fund in the land. Always good to see you. Thank you, my friend. Have a good evening.
Thank you, Bill.
Time to take a look at some of today's upgrades and downgrades. FedEx's rating was lifted to outperform today from market reform at Bernstein. The firm calls concerns over Amazon moving into the parcel market overblown. The price target was increased to $290, and FedEx shares rose nearly 3% today to $252.22. Meanwhile, FedEx rival UPS saw its rating cut to hold from buy at Deutsche Bank. The analyst there says that management needs to articulate a sound strategy on price and volume when it comes to competing with Amazon. The firm's price target on UPS is 115. Shares of UPS were up a fraction to 105.61 today. Meanwhile, shares of Amazon itself were upgraded to outperform from peer perform at Wolfe Research. The firm says that Amazon's grocery operations could turn physical retailing into a new growth driver for the company, interestingly enough. The analyst predicts that the stock could hit, ready, $2,000 before the end of the year. Amazon was up 1%. It closed right at $1,500 a share today, interestingly. Still ahead, if cereal and yogurt are not getting the attention of American shoppers, General Mills is betting that pet food will. Kraft Heinz says that Warren Buffett is going to retire from that company's board following the end of his term. Heinz, backed by Buffett's Berkshire Hathaway and a Brazilian private equity firm, acquired Kraft Foods back in 2015 in order to create one of the biggest food and beverage companies. Berkshire Hathaway will release its shareholder letter this weekend, by the way. And General Mills, of course, feeds your family. Well, now it wants to feed your pet as well. The food company is moving into the very fast-growing pet food business with this $8 billion purchase of Blue Buffalo. Shares of Blue Buffalo soared by 17% on the news today. General Mills fell in today's trade. Dominic Chu takes a look at what drove this deal for us.
There's a huge reason why a big food company like General Mills wants a dog food company like Blue Buffalo. When you're going to marry these brands, you've got Betty Crocker, Lucky Charms, Pillsbury, Progresso Soup on the General Mills side, and you marry them with the organic, natural dog foodish, premium dog food side of things. This side is showing signs of more stagnant growth. This side over here is where there's double-digit sales and profit growth, and that's the reason why they're paying $8 billion to buy Blue Buffalo. Now, the reason why they want to do this in this kind of growing environment is because the overall market for pet products is also growing. According to the American Pet Products Association, back in 2013, Americans spent overall around $55.5 billion. That was the size of the pet industry. Steadily, it's grown till now in 2017, where you can see an estimated near $70 billion. That's the size of the pet industry in America these days. So the bigger picture for pets are growing as well. Now, with General Mills' entrance into this particular pet food side of things, they're a late entrant. There are big established players in this industry right now. Mars, yes, that same candy company Mars, has Pedigree, Iams, Eukanuba, Whistle among its big pet brands. You've also got Nestle. Anything Purina is owned by Nestle, and even J.M. Smuckers has big names like Meow Mix, Kibbles and Bits, and Milk-Bone dog biscuits. So when we talk about pets, Americans don't just spend a few billion here and there. It's a massive industry. General Mills wants in, and that's arguably the reason why they're paying up big bucks to get a piece of that Blue Buffalo business. For Nightly Business Report, I'm Dominic Chu.
Cinemark earnings blew past analysts' expectations, and that's where we begin tonight's Market Focus. Ticket price increases and higher concession spending helped the movie theater operator record quarterly revenue. Cinemark also raised its dividend by 10% to $1.28 a share, and shares themselves rose by 6% today to $42.27. Meanwhile, investors had their first chance to react to Wingstop's disappointing earnings outlook. But the CEO of the chicken wing restaurant chain said that he is still forging ahead with plans to expand.
We've been developing restaurants at a very rapid pace, both in the U.S. and overseas. Last year, we opened 135 net new locations, which represented more than 13% growth year on year. And our long-term guidance is for 10% plus continued unit growth for the chain.
Shares of Wingstop fell by 5% today to $44.38. And investors also reacted today to downbeat guidance from Intuit late yesterday. The maker of TurboTax cited the late start to tax filing season, but the CEO did say future business is looking up.
We're out of the gate strong. Right now, the IRS has received about 1% fewer returns than last year at this point in time. We're actually up 2%, so we're gaining a little bit of share, and we're feeling good about the year.
Stock closed fractionally lower to $171.78. Nordstrom's founding family is reportedly working on a deal to take the upscale retailer private. According to the Reuters, the family recently met with investment banks. They are hoping a deal could happen as early as next week. Of course, the Nordstrom family initially suspended earlier efforts to go private after they could not secure the necessary financing. Now, this late news today sent the stock soaring by 6.5% to $53.56. Time now for our weekly market monitor, who has 3 picks that he says are helping to drive the U.S. economy. This is his first time on our program. Jordan Waxman is managing partner at HSW Advisors at Hightower. Jordan, good to see you. Thanks for joining us tonight.
Again, Bill. How are you?
Now, you're looking at 3 categories here that you feel drive the economy, and let's go through them here. First of all, the area of credit, and you've chosen a company, Carlyle's Business Development Corp. Why credit?
You know, most of the economy in the United States is small and medium-sized businesses. They need access to capital. It's an underbanked part of the market. If you want to play the larger credit picture, the banks are a place to go. But if you're a small or medium-sized business, you have to borrow. From some source, and funds like Carlyle's fund or Goldman Sachs has a fund. These business development corps are essentially pools of loans to small and medium-sized businesses.
And like a lot of banks and financially oriented companies, presumably as rates go higher, they benefit. Is that the idea?
Well, all of the loans that Carlyle issues are floating rate loans. So as short-term rates go up, they pay more interest.
Yeah.
However, since tax rates have gone down for corporations, now's a great time to be lending because the credit metrics have been stronger. The ability to pay back loans has been stronger. So companies that have $5 to say $25 million of EBITDA that need to tap the markets, they need to go somewhere.
So that's Carlyle's Business Development Corp. Another area you see growth, energy infrastructure. We keep hearing about the infrastructure plans of the government. You chose Enterprise Products. Tell us about it.
Well, think about what's really been going on in the United States, which is that it's gone from being a net importer of energy to a net exporter of energy. Energy Partners has assets in some of the most attractive basins for oil, natural gas, and natural gas liquids in the United States, and they're getting demand for all of those products from chemical companies, from utilities that are changing to natural gas, and from the export market, where finally the United States is exporting all 3 of those products and all of the ethane and butane and all the sub-products as well. Enterprise Products is very well managed. The group, Master Limited Partnerships, of which this is a part, is hated, and you're getting a 6.5% yield with 2 or 3% growth. Great management team, clean balance sheet, very, very good way to enter that market.
Finally, your third area of growth for the economy, innovations, broad category, and you picked a big one. Alphabet.
Well, think about it, right? Most clients who can invest in venture capital funds have to be very, very wealthy to get in. Most of them they're closed to new money. It's tough to get access to robotics and medical devices and financial services technologies, a portfolio of venture investments. This is a way to get in where you're paying basically 25 times earnings for a company with $30 billion of free cash flow that's making investments in every aspect of technology. They've made over 200 acquisitions in the past 15 years. They're repatriating over $100 billion of cash. This is going to be a way to tap the innovation in the market for the next decade or more.
All right. Very interesting. Jordan Waxman of HSW Advisors at Hightower. Thanks for joining us tonight, Jordan.
Thank you, Bill.
It. By the way, those rising interest rates we mentioned at the start of the broadcast are causing mortgage rates to rise, of course, just as the spring housing market gets underway. What exactly will that mean for the wallets of potential buyers? Diana Olick does the math for us tonight.
If you're house hunting this weekend, you probably already know that you'll be paying more on your mortgage than you would have been at the start of this year. Rates were still near historic lows in December, but began to rise in January and then took off this month. So what exactly does that mean to a buyer's pocketbook? Well, first, let's make the loan amount $300,000. That's right between the median price of an existing home and a newly built home. Using a 30-year fixed mortgage with 20% down payment, the borrower's monthly mortgage payment on January 1st of this year would have been $1,472. Today, it's about $1,545, so an increase of $73 per month or $874 per year. But interest rates don't just dictate your monthly payment, they also dictate how much of a mortgage you can qualify for. Lenders today are very strict with the amount of debt you can carry as compared to your income. So let's say that on January 1st, the maximum loan you could qualify for with your income level and debt was $300,000. Today, with the higher interest rate, you would only qualify for $285,000, or about 5% less house. So, again, with the 20% down payment, you've gone from being able to afford a $375,000 house to a $357,000 house. That may not seem like a huge difference, but for those on the margins or with more debt, higher rates mean you can buy less house or potentially no house at all. For Nightly Business Report, I'm Diana Olick in Washington.
And coming up, traveling in a flying car certainly sounds futuristic, but air taxis may be closer to reality than you think. The beer industry is toasting a provision in the new tax law that provides temporary financial relief, and a number of businesses may pour the savings back into their operations. Landon Dowdy is in Stamford, Connecticut with that story tonight.
The owner of this brewery is raising a glass thanks to a provision in the new tax code that provides 2 years of tax relief.
We'll end up saving about $15,000 this year, right? And so we were going through a whole budgeting process ourselves.
Under the new law, the excise tax paid by brewers on each barrel of beer they sell is reduced to $3.50 from $7 for the first 60,000 barrels. That's a big savings for brewers like Half Full, who produce less than 2 million barrels a year. For larger breweries, the tax drops from $18 down to $16 on the first 6 million barrels. They'll pay $18 on every barrel after that. Experts say that could lead to growth across the industry.
I think we're going to see the creation of jobs. I think we're going to see a spur in innovation in beers of all kinds. 2.2 million Americans owe their livelihoods in one way to another to the production, distribution, and sale of beer. And we think that this tax relief is going to spur that even further.
Analysts expect larger breweries to use the extra money to hire more employees, where smaller ones may try out some new products. Here at Half Full Brewery, the extra cash will allow the company to be more innovative and focus on trends like limited released beers and tasting rooms.
Things that we're actually not sure are going to work out and actually translate. Like at the end of the day, you might have it and you're going to be like, ooh, this is kind of weird and not my taste. But it allows us to experiment with that and potentially like have it fail, but not have it really impact us.
Spirit makers and wineries will also see a reduction in taxes, totaling billions of dollars in savings. Savings that the industry hopes will translate into new growth. For Nightly Business Report, I'm Landon Dowdy in Stamford, Connecticut.
Cloud storage company Dropbox has filed to go public, and that has given investors their first look at the financials of this startup that was previously valued at around $10 billion. It turns out the company pulled in more than $1 billion in revenue last year, and it has 500 million registered users. Dropbox plans to trade under the NASDAQ symbol of DBX. Chinese government has seized control of a firm that owns the Waldorf Astoria Hotel in New York. The regulator has taken control of Anbang Insurance, saying that its decision was because of illegal operations that could endanger the company's ability to stay in business. The chairman of Anbang is also being prosecuted for what are being called economic crimes. Volkswagen saw its profits double despite the fallout from the diesel emission scandal. The automaker benefited from strong sales and cost cutting at its flagship VW brand, and it expects revenue to increase this year. But the company's CEO did warn of challenges, including more competition and big bets on electric vehicles and self-driving cars. Sort of speaking of which, ever since the Jetsons were on television back in the 1960s, people thought it would be cool to someday zip around in a flying car. Well, now some aerospace companies and entrepreneurs and tech firms are racing to make that a reality. How close are they to taking off? Phil LeBeau takes a look for us tonight.
This is the Vahana Air Taxi, a prototype built by Airbus, which made a brief but successful first flight last month in Oregon. After years of building traditional planes, Airbus is exploring the idea of small aircraft carrying 1 or 2 people short distances. Boeing is doing the same thing, though its prototypes are not yet ready for humans to climb on board. That's not the case with Kitty Hawk, Last year, the startup founded by Google's Sergey Brin showed a man piloting the Kitty Hawk Flyer as it zipped over a lake in Northern California. This video, along with animation from Uber showing a fleet of air taxis it would like to develop, highlight the appeal of developing flying cars. With highways more congested than ever, it would make sense to have a small aircraft moving people short distances, in trips that could be 4 times faster than riding in a car. That's why many believe this could be how we get around in the future, with one notable exception, Elon Musk. While Musk has been a visionary developing electric cars through Tesla, pushing space exploration through SpaceX, or giving us the idea of the Hyperloop, he is skeptical we will want air taxis. He recently tweeted sarcastically, "If you love drones above your house, you'll really love vast numbers of cars flying over your head that are 1,000 times bigger and noisier and blow away anything that isn't nailed down when they land."
What do regulators like those with the FAA think of air taxis? Well, it's an area they're exploring. And you can bet if we ever get to the point where some of these air taxis are ready to fly, the federal government will be ready with laws to make sure it's safe for us to take to the skies. Phil LeBeau, Nightly Business Report, Chicago.
Before we go, one more look on the day on Wall Street and the week for that matter. The Dow gained 347 points during a big rally at the close. The Nasdaq added 127, the S&P up 43. All the indexes were higher for the week as a result of this rally. That's Nightly Business Report. I'm Bill Griffith. Thanks for watching. Have a great weekend. Hope to see you on Monday.